Many of you have probably heard about index funds, mutual funds, and exchange-traded funds. But what are those, and what are the differences between them? An index fund is a fund that tracks a certain market index. In other words, an index fund holds assets that are combined according to a market index. What is a market index then? A market index is a collection of stocks that represent a certain market or a sector. For example, an S&P 500 tracks 500 biggest U.S. companies by market capitalization. And Dow Jones U.S. Healthcare Index tracks the U.S. healthcare sector. A mutual fund is created from a money pool of many investors. It can track stocks, bonds, cash equivalents, or can be a hybrid and track multiple different asset types. It can also be traded on the stock exchange only once a day. Mutual funds, however, don't offer voting rights on the purchased stocks. An exchange-traded fund, or ETF in short, is very similar to a mutual fund. It is also constructed from a combined money pool and can track various asset types. However, it can be traded on the stock exchange any amount of times per day. Index funds are automated and require no active management. So, the trading's fees for those are lower than for actively managed funds. Both mutual funds and ETFs are usually actively managed, so the fees might be higher. All the funds usually provide good diversification options. They also can offer multiple risk profiles to their investors. Which funds are the most useful for you? Let me know in the comments below. Thank you for watching. Please, like this video and subscribe to my channel. See you in the next one. Jesse, power off.